What's going on, everyone? In this video, we'll be going over and covering the topic of order blocks, specifically what an order block is, what makes a valid versus what makes an invalid order block, how can we spot them, and we'll be going over some live examples of them. So let's get into it. An order block is a price area on a chart where large buying or selling activities took place, usually by institutions or smart money. These areas often lead to strong moves in price and can act as either a support or resistance when the price returns to them. Order blocks are used by SMC, also known as smart money concepts. They are used to spot where the big players has entered the market. When price revisits these areas, it often reacts again, making them useful for trade entries. Now, a bullish order block is the last bearish candle before a strong upwards move. It shows where smart money placed buy orders and pushed the price higher, and it also acts as a support zone. On the other hand, a bearish order block is the last bullish candle before a strong downwards move. It shows where smart money placed sell orders and drove the price lower. This acts as a resistance zone. The idea behind using order blocks as potential reversal zones is based that they often form just before a significant move. These zones are thought to be areas of manipulation where smart money enters the market after sweeping liquidity. Traders see these zones as key points where a large number of buy or sell orders have been already executed. Because of this, when price returns to these areas, there's a high probability of reaction or reversal. Order blocks are important tools for identifying areas where strong buying or selling took place. They can offer high probability trade setups when used correctly. However, not every candle that looks like an order block is actually valid. To avoid false setups, it's important to know what truly defines as a valid order block and what to ignore. To filter out weak setups, there are four key rules or four key elements that you should follow. A valid order block must meet all of these requirements and conditions. A liquidity sweep. The order block candle must take out the high or the low of the candle that came before it. In a bullish setup, the bearish candle should break below the previous candle's low. And in a bearish setup, the bullish candle should break above the previous candle's high. This shows that the market grabbed liquidity, stop losses were triggered, or traders were trapped by the reversal. Without this sweep, the candle lacks manipulation that the smart money usually creates before entering. Let's take a look at this bullish scenario. On the left, price moves down and forms a valid order block by sweeping the low of the previous candle before reversing upwards. This sweep of liquidity confirms manipulation before the shift in direction, making the last bearish candle a valid order block. On the right, price also moves down, but the last bearish candle does not take out the previous candle's low. Since there is no liquidity sweep, this candle does not qualify as a valid order block, even though the price still moves higher afterwards. Now, the next criteria is an imbalance, price inefficiency. After the order block forms, the price should move away quickly, leaving behind an imbalance. This happens when there's a gap between the candles, meaning that the wicks don't overlap. This imbalance shows urgency and strength in the move. It confirms that large orders were involved and that the price moved too fast for regular buyers or sellers to fill in. If there is no imbalance, the move may be weak and the order block is not considered valid. Look at the example below for a bullish scenario. On the left, the order block is valid because the subsequent candles leaves a clear gap, meaning there's an imbalance. Price moved quickly, leaving unfilled orders behind, and this shows strong momentum. And on the right, the order block is invalid because the subsequent candles overlap. meaning no imbalance was left. The move was balanced and not driven by urgency. The same rule also applies to a bearish setup. A valid bearish order block must be followed by candles that leave a gap. If there is no gap, the order block is not considered valid. The next criteria is an unmitigated zone. A valid order block must stay untouched after the move. If the price immediately returns and trades into that zone, it's considered an invalid order block. Order blocks are typically used once. The first time the price returns to that zone, and after that, the level becomes less reliable. Now, the final and last criteria will be a break of structure or a change in direction. The move following the order block must break a key structure level. In a bullish case, the price should break a recent swing high, and in a bearish case, the price should break a recent swing low. This confirms that the market didn't just pause, it actually changed direction. If there's no structure break, the move lacks confirmation, and the order block may not hold. Now, let's take a look at an example. In the image, we can see two valid bullish order blocks, each followed by a strong move upward. After each order block, the price creates a visible imbalance and then breaks above the recent swing high. This is what we call a break of structure. The break of structure confirms that price didn't just bounce temporarily, it actually shifted direction and continued higher. When the structure break happens after an order block, it adds strong confirmation that the level was valid and backed by real momentum. Okay, now that we're done listing off all the criteria needed to find a valid order block, let's go on to the charts and look at some real live chart examples of a valid order block. Okay, so here on the charts, you can see that this is the high right here. Now we'll fast forward and see how price plays out. And as you can see, price broke above this high. Price broke above this swing high, leaving behind an imbalance and an order block. So we had all criteria have been met, and now we can consider this a valid order block. You can see price broke structure, price made an imbalance, price did not return to this zone, and price swept liquidity from the previous candle. Now we can consider this a valid order block. We'll fast forward and see how price plays out into this order block. And as you can see, price returned to both the imbalance and the order block to then gave off a rejection to continue upwards. Okay, now let's go ahead and take a look at another order block example. As you can see, price made a clear low right here. And you see price then broke structure below this low, leaving an order block. Now to see if this is a valid order block, you must check the criteria to see if it's valid or not. So we have a broke of structure to the downside. That's a criteria checked off. You have a swept of liquidity from previous candles high. That's a criteria checked off also. We have an imbalance made. We have an imbalance made when price was swept. That's also a criteria checked off, and we do not have an unmitigated zone. So this all leads us to a valid order block. Now let's extend the zone over and see how price plays out into this zone. As you see, price then returns back into this zone to then give a rejection to go downwards. Now let's fast forward some more to see how price plays out. As you see, price then returns back into the zone to give another rejection to the downside. So once all criteria have been met, you can then consider this a valid order block. Before you go, let me know in the comments what you want next. And don't forget to subscribe if you're leveling up with me. This is the Trading District, and I'll see you in the next breakdown. See ya.